Okay, let's unpack this. We are back with another deep dive, and today we're going back to school, but not just any school.
Hey, that's one way to put it.
We are tackling the source material for the NISM Series-X-A certification. Specifically, we are zooming in on Chapter 5, Introduction to the Indian Financial Markets.
That's right. And for anyone listening who is preparing for this exam, or even just someone who wants to understand the plumbing of the Indian economy, this is a crucial foundational chapter.
It really feels that way.
It is dense, it is technical, and it is absolutely essential.
I was reading through the source material, and it struck me, usually we talk about the economy like it's this vague cloud that rains money or debt.
Right, you hear the headlines.
Exactly. We hear about GDP, we hear about inflation, we hear about the Sensex hitting a new high. But this chapter, it's not about the cloud. It's like opening up the hood of a car.
That is actually the perfect analogy to start with. Imagine the Indian economy is a massive high-performance engine. It has incredible potential power manufacturing, services, agriculture, all of it. But here is the catch. An engine sitting on a concrete floor, revving its heart out, doesn't actually move anything.
It's just making noise.
A lot of noise. You need a transmission system to take that raw power and transfer it to the wheels so the car actually moves forward.
And in this analogy, the financial markets are the transmission.
Exactly. Today, we aren't just looking at the engine. We are taking apart that transmission system, the financial markets that keeps the wheels turning.
Okay.
We are going to look at the gears, the belts, the lubrication, and most importantly, the engineers who make sure the whole thing doesn't explode, the regulators.
I love that. So what is our roadmap for this session? Because there are a lot of acronyms in this text, and I want to make sure we don't get lost.
We have a clear path broken down into three main buckets. First, we'll look at the big picture, the evolution of the Indian economy, and the specific role financial markets play.
Right. The why.
Why, second, and this is the heavy lifting, we are going to break down the regulators. Who actually makes the rules?
The engineers.
The engineers. Then third, we'll dissect the structure of the markets themselves, banking, securities, insurance, and pension.
And just so everyone knows the ground rules, usually on the deep dive, we summarize. We give you the too long, didn't read version. But you were pretty adamant that we do things differently today.
Yes. If you are taking the ESM Series-X-A exam, summarizing is dangerous. This test is notorious for asking about specific details, specific list items, and specific definitions.
So no skipping.
No skipping. If the text lists 5 departments under the Ministry of Finance, we need to discuss all 5. If there's a specific rupee limit on a payment bank account, we need to flag it. So, my rule for today is we don't skip the details. We are going for comprehensive coverage here.
All right, no shortcuts. I'm ready. Let's start with Section 1, the Indian economy and financial markets. The text starts with a bit of a history lesson, doesn't it?
It does. It contextualizes where we are now by looking at where we came from. Historically, India was, an agrarian economy. Agriculture was the backbone.
That's what we all learned in school.
Right. But the text highlights a significant structural shift. We have transitioned to an economy that is now dominated by services and manufacturing.
Dominated by how much? Is there a number on that?
There is. They now contribute about 3/4 of our GDP.
3/4. That is a massive shift.
It's a completely different center of gravity. And
Right.
when you have an economy based on manufacturing and services, the requirement for capital changes. A farmer needs seeds and fertilizer, which is one scale of finance.
Okay.
But a tech company or a car manufacturer needs massive infrastructure, servers, factories, global supply chains. Scale is just different.
Right. So economic growth in this modern system depends heavily on a robust financial system to access those resources.
Precisely. The text says financial markets keep the wheels of the economy running. But let's be specific about how. The text lists 5 specific roles. I want to go through them one by one because the exam often draws conceptual questions from this list.
Okay, hit me with them. Let's walk through the 5 roles.
First, banks. Their primary role is providing credit to corporates and individuals and serving as a savings channel. They are the bedrock.
The absolute foundation. Got it.
Second, securities markets. This is about equity and debt offerings, helping businesses raise funds directly from investors.
That's the stock market side of things.
Mostly, yes, but also the bond market. Can't forget the bond market. Third is Forex markets. This is crucial for an economy that imports energy and exports services. It handles import costs and enables global investments while mitigating currency risk.
Right, because if the rupee fluctuates wildly, your entire business plan can just fall apart.
Exactly. Your profit margin disappears overnight. Fourth is commodity markets. Their main role is managing price volatility. Think of the farmer or the metal manufacturer locking in prices so they can predict their costs.
Okay, so it gives them some certainty.
Certainty in a very uncertain world. And finally, the fifth role is insurance, which protects against financial shocks.
So just to recap, banks for credit, securities for capital, Forex for trade, commodities for volatility, and insurance for protection. That's the whole ecosystem.
That's the ecosystem. Now let's drill down into Section 5.2, the key features of financial markets. The core function here is very specific, channeling surplus funds from investors, the lenders, to the borrowers.
And the borrowers of businesses or the government, right?
Correct. And the bridges that make this happen are the intermediaries, banks, mutual funds, insurance companies. They connect the people with money to the people who need money.
Okay.
But here's where it gets technical, and this is a classic exam topic. You need to understand the categorization of markets based on time.
Time. You mean how long you borrow the money for?
Exactly. The text makes a hard, crucial distinction between money markets and capital market.
Okay, let's unpack this. What's the cutoff line?
1 year. It's that simple. If the lending and borrowing is for less than 1 year, you are in the money market.
Okay, short term.
Very short term. If it is for long-term funding, typically via debt and equity, you are in the capital market.
Okay, simple enough. Less than a year's money market, more is capital market.
Got it.
What about the primary versus secondary distinction? That always confuses people.
It's a common sticking point. Think of it like buying a car.
Okay, I like analogies.
The primary market is the showroom. You are buying a brand new car directly from the manufacturer.
So the money goes to the company that made the car.
Precisely. In finance, this is when a company issues new securities like an IPO. The money goes directly to the company to fund its growth, to build a new factory, to hire people.
And the secondary market.
That's the used car lot. Or, in our case, the stock exchange app on your phone. If you open Zerota or Grow and buy shares of Tata Motors from a guy named Steve in Mumbai, that is the secondary market. Tata Motors doesn't see a rupee of that money. Steve gets it. You are just trading previously issued securities among investors.
That's a really clear distinction. Primary builds the capital for the company. Secondary provides the liquidity for the investors.
You've nailed it. And the text emphasizes that both are vital. You can't have a primary market if people don't believe they can sell the assets later in the secondary market. One can't exist without the other.
Clear. Now, let's move to the part that I think scares students the most, Section 2. The regulators. This is the part with all the acronyms.
It shouldn't be scary, but it does require precision. You can't be vague here. The philosophy of regulation, according to the text, is safeguarding investor interests and ensuring a fair understanding of the markets.
So who is the boss here? Is there one big boss at the very top?
That's a great question. At the absolute top of the pyramid regarding monitoring the whole system, we have the FSDC, the Financial Stability and Development Council.
FSDC. That sounds like a heavy hitter.
It is. The text calls it the apex body. Its role is monitoring macroprudential supervision and financial inclusion. It's not looking at whether one bank branch is following the rules.
It's looking bigger.
Much bigger. It's looking at whether the entire financial system is stable or if there's a risk of it collapsing, like in 2008. It's about systemic risk.
Okay, so FSDC is the overseer. But beneath that, we have the actual machinery of the government. The Ministry of Finance, or MOF.
Yes, and this is where students lose marks. You cannot just say the Finance Ministry. The MOF has 5 distinct departments. I want to walk through each one because the exam loves to ask you which department handles what.
5 departments. Okay, let's list them. First one.
The Department of Economic Affairs, DEA.
DEA. What's their lane?
This is the nodal agency for macroeconomic policies, so monetary and fiscal policy, and the functioning of capital markets and stock exchanges.
Wait, hold on. I thought SEBI handles stock exchanges. That's what everyone says.
And that is the classic exam trap. SEBI regulates them day to day, the operations. But the DEA handles the broader policy framework.
How so?
Think of the DEA as the architect who designs the building. They set the high-level rules. SEBI is the building manager who makes sure the tenants follow the rules every single day.
Got it. Architect versus manager. DEA is the architect. Okay, that helps.
Yep.
Second department?
The Department of Expenditure. The name is a bit of a giveaway.
I'm guessing they handle spending.
Exactly. They administer financial rules, service conditions of central government employees, and handle financial assistance to states.
So, salaries for central gov employees and funding for states. That's expenditure. Simple enough. Third,
The Department of Revenue, another easy one. They control direct and indirect taxes. So the CBDT, which is the Central Board of Direct Taxes, and the CBIC, Central Board of Indirect Taxes and Customs, both fall under this department.
Taxes equals revenue. Easy. Fourth one.
Okay, now this is the one you must flag. Put a big red circle around it in your mental notes. The Department of Financial Services, DFS.
DFS. Why do we need to flag this one? Why is it so tricky?
Because people confuse it with the Department of Economic Affairs all the time. Remember how DEA was the architect for the markets?
Right. The policy people.
Well, the DFS regulates the institutions. It looks after public sector banks, PSBs, the insurance sector, and the pension sector. It manages the entities themselves.
Okay, let me try an example. If the government decides to merge two public sector banks or change the rules for insurance companies, that's DFS.
Correct. But if the government is changing the overall inflation target policy for the economy, that is DEA. See the difference? DFS is about the entities, the banks, the LICs. DEA is about the markets and the economy.
Market policy versus institution management. Got it. And the fifth one?
The Department of Investment and Public Asset Management, DIPAM.
That's a mouthful. DIPAM.
It is. Their role is managing disinvestment of central government equity. Basically, they're in charge of selling the government's stakes in public sector undertakings, or PSUs.
Okay, so 5 departments. DEA, Expenditure, Revenue, DFS, and DBAM.
Done. Good. Now, moving sideways from the Ministry of Finance, we have another ministry, the Ministry of Corporate Affairs, MCA.
MCA. Their main job is the Companies Act, right?
It's their primary role, yes. The Administration of the Companies Act, 2013.
That's the rule book for how every company in India has to operate.
Exactly. It's the Bible for how companies are born, how they live, and how they die. But the MCA also oversees a few other key acts, like the Limited Liability Partnership Act, 2008, and the Competition Act, 2002.
The Competition Act that created the CCI.
Yes, the Competition Commission of India. Their job is to prevent monopolies and any practices that hurt healthy competition in the market.
And the MCA also supervises the professional bodies, the accountants and people like that.
Correct. The ICAI for chartered accountants, the ICSI for company secretaries, and the Institute of Cost Accountants. The MCA is the parent ministry for all of them.
And isn't there a specific person or office under MCA that actually registers companies, the one you deal with when you're starting up?
The Registrar of Companies, OC. That is the specific authority appointed to register companies and ensure they comply with the law. If you start a private limited company, you're filing your papers with the ROC.
Okay, now we get to the heavyweights, the ones everyone has heard of. The Reserve Bank of India, the RBI. The text actually quotes the preamble of the RBI.
It does, and the language is quite beautiful, really. It says the RBI's purpose is to regulate the issue of banknotes, keeping of reserves, to secure monetary stability in India, and generally to operate the currency and credit system of the country to its advantage.
To its advantage. I like that. It implies a strategic guiding role, not just policing.
It does, and it continues. To have a modern monetary policy framework to meet the challenge of an increasingly complex economy, to maintain price stability while keeping in mind the objective of growth.
Price stability versus growth. That's the eternal struggle, isn't it? The central banker's dilemma.
It is. If you raise interest rates, you fight inflation, but you might slow down growth. If you lower rates, you can boost growth, but you risk inflation taking off. It's a constant balancing act.
So for the exam, what are the functions we need to know?
The text lists 6 key functions. You should be able to recognize them. 1, formulate and monitor monetary policy.
Okay.
2, maintain price stability or inflation control while keeping growth in mind. 3, regulator and supervisor of the financial system, especially banks.
Right.
4, manager of foreign exchange. 5, issuer of currency. And 6, regulator of payment and settlement systems.
Like UPI and EKST.
Exactly. That's all under the RBI's purview. They keep the digital payments plumbing working.
Okay, that's a lot of ground. So RBI is the money and banking regulator. What about SEBI?
The Securities and Exchange Board of India, the big one for the markets. It's a statutory body established by the SEBI Act, 1992, flagged that year.
Me too. Got it. What's their mandate? What are they trying to do?
We call it the triple mandate, and it's right there in their preamble. It's simple and powerful. 1, protect the interests of investors.
Number 1 priority.
Always. 2, promote the development of the market. And 3, regulate the market.
Protect, promote, regulate.
Exactly. And their functions, which are exam favorites, include things like regulating stock exchanges, registering intermediaries like brokers and mutual funds, prohibiting unfair trade practices like insider trading, conducting audits and inspections, and importantly, investor education.
Okay, so we have the money regulators, RBI, and the market regulators, SEBI. What about insurance and pensions? Two different bodies, right?
Two different bodies. For insurance, we have IRDAI, the Insurance Regulatory and Development Authority of India.
And their act. What year was that?
The IRD Act of 1999. Their role is pretty clear. Protect policyholders, register insurance companies, and specify solvency norms.
Solvency norms. That just means making sure the insurance company has enough money to actually pay claims when they
Yes.
come due.
Right. Precisely. You don't want an insurer to go bust just when you need a claim paid. IRDAI makes sure they are financially healthy.
It makes sense. And pensions.
For pensions, we have PFRDA, the Pension Fund Regulatory and Development Authority. They regulate the pension sector, and specifically the National Pension System, or NPS.
So they register the pension fund managers, approve the different investment schemes, that sort of thing.
Yes, and they handle grievance redressal for subscribers.
Okay. Before we leave regulations, there's one more acronym in the text. SRO. A self-regulatory organization. What is that?
This is a fascinating concept. An SRO is an organization of intermediaries representing a specific segment of the market. Think of it like an association of stockbrokers, for example.
Young.
According to the SEBI SRO regulations of 2004, an SRO must be registered with SEBI.
So it's like a club that polices its own members, but with SEBI's blessing.
That's a perfect way to describe it.
Yeah.
It functions as a first-level regulator, creating norms and codes of conduct for its members. It's a way to delegate some of the day-to-day oversight.
But the text made a weird exception, didn't it?
A very nuanced point, yes. The text notes that stock exchanges are excluded from this specific SRO definition in this context, even though they obviously have a lot of regulatory powers over their members. It's a technical distinction, but one to be aware of.
Interesting. Okay. I think my head is full of regulators now. Let's move to Section 3, the structure of financial markets. And we start with the big one, banking.
The banking system is at the core, and the RBI performs its supervisory function under the guidance of a specific body called the BFS, the Board for Financial Supervision.
We know what banks do, take deposits, give loans, the basics. But the text breaks down the types of banks in a lot of detail.
It does, and you need to know the categories. We have
Sure.
the big commercial banks, which include public sector banks, private banks, and foreign banks. Then you have cooperative credit institutions, which are often urban or rural focused.
Right. But the exam loves the newer categories, doesn't it? Like payment banks and small finance banks.
Absolutely. Let's talk payment banks. I'm sure you use one.
Yeah, I use Paytm and Airtel Payments Bank. What defines them, technically? What are the rules?
Their main goal is financial inclusion, reaching people who don't have traditional bank accounts. But there are very strict limits. Now, flag this number for the exam. A payment bank cannot hold more than 100,000 per customer.
1 lakh. That's the hard limit.
Hard limit. And here's the other big rule. Can they lend you money?
I'm going to guess no.
Correct. That is the big restriction. Payment banks cannot lend money or issue credit cards. They can issue ATM or debit cards, but absolutely no credit. They are strictly for payments and savings up to the limit.
Okay, so what about small finance banks? They sound similar.
They have a similar goal of inclusion, but their focus is to supply credit to small businesses, the unorganized sector, small farmers, and micro-industries. They can lend, unlike payment banks. They operate much more like a regular bank, just on a smaller scale.
And then we have NBFCs, non-banking finance companies. I always struggle with this. How is an NBFC different from a bank?
Two main differences. You must know these.
Yeah.
One, NBFCs cannot accept demand deposits.
Demand deposits, you mean like a checking account where I can write a check?
Exactly. You can't open a checking account with an NBFC. And two, and this is a big one for savers, they do not have deposit insurance from the DICGC.
So if a bank fails, my deposits are insured up to a certain limit.
Correct. Up to 5 lakh rupees. If an NBFC fails, that government safety net isn't there in the same way.
That is a huge distinction for a saver. Wow.
Absolutely. Their main activities are loans, leasing, and hire purchase. Think Bajaj Finance.
Got it. The text also mentions specialized finance, housing finance companies.
Yes, HFCs. The important update here, which the text notes, is that they used to be regulated by the National Housing Bank, NHB, but they are now regulated by the RBI. Another point to flag.
And P2P lending. Peer-to-peer.
Yeah.
That's becoming really popular.
It is. It's basically an online platform that connects people who want to lend money directly to people who want to borrow, so it's unsecured lending between individuals. The text notes that this is now regulated by the RBI to reduce some of the risk.
So the RBI is trying to put some guardrails on it.
They have to. It's high risk, so the regulator steps in to ensure the platform does its due diligence, even if they don't guarantee the loan itself.
Okay, let's go back to the money market. We defined it as short-term, less than a year, but what are the actual instruments traded there?
The text lists several, and you should know the names and the tenors. Call money is essentially overnight lending between banks to manage their daily cash reserves.
Just one day.
One day. Notice money is similar, but for a slightly longer period, up to 14 days.
So call is 1 day, notice is up to 2 weeks.
Correct. Then you have things like commercial paper, CP, which is short-term debt issued by companies, certificates of deposit, CD, from banks, and treasury bills, T-bills, issued by the government, all short-term debt instruments.
Okay, moving to the foreign exchange market. The text talks about currency pairs and how to read them.
Yes, this helps you visualize a quote. If you see USD INR, the first currency, the USD, is the base currency. The second, the INR, is the quoting currency.
So the quote, say 83.50, tells you how many units of the quoting currency, INR, are needed to buy 1 unit of the base currency, the US dollar.
You've got it perfectly. And the text mentions a specific entity here, FBIL Financial Benchmark India, PVT Ltd. They are the ones who publish the official daily reference rates for currencies.
Right, data is the new oil. And Section 3 ends with data and information systems, specifically credit and information companies or CICs.
Yes. We usually just say CIBIL score, but CIBIL is just one of the companies. The text lists 4: CIBIL, Equifax, Experian, and CRF Highmark.
And they're regulated.
Yes, by the CIC Regulation Act of 2005. They produce what are called Credit Information Reports, or CIRs. Now, here's a consumer rights flag for the exam.
Okay, what is it?
The text states that CICs have a mandate to furnish 1 free full credit report, FFCR, per calendar year to any individual who asks for it.
Only one. I thought you could check it more often on some apps.
You can, but they are mandated by law to give you 1 full report for free each year. You might have to pay for others or access summary scores through third-party apps, but you have a right to 1 free detailed report.
Good to know. And there's a new entity mentioned, account aggregators, AA. What do they do?
This is a really interesting new framework. They allow you to share your financial data from, say, your bank account or mutual fund statement with a third party, like a new lender or a financial advisor. But, and this is the key, only with your express consent.
So it's designed to make my life easier if I'm applying for a loan, for example.
Exactly. It makes lending or financial planning faster and more seamless because all your data can be consolidated securely and with your permission.
Okay, that wraps up the massive world of banking. Let's move to Section 4, securities market structure. This is where we get into the nitty-gritty of what a security even is.
Yes, and for that, we have to look at a very specific law. The SCRA 1956, the Securities Contracts Regulation Act. Section 2 of that act gives us the legal definition. It's a laundry list, and you need to recognize all of them for the exam.
Okay, let's run through the list. What qualifies as a security?
All right. First, the obvious ones: shares, scrips, bonds, debentures.
Standard stuff.
Then derivatives. Next, units of collective investment schemes, or CIS. Also, security receipts, which are issued under the Sarfeesi Act. Units of mutual funds are specifically listed.
Even though they just hold other securities.
Right, the unit itself is a security. Also, government securities. And finally, a catch-all: rights or interests in securities.
Wow, that seems to cover pretty much anything you could trade.
It is meant to be very broad. Now, let's talk about the plumbing that makes all this trading possible. The market infrastructure institutions, MIIs.
MIs. Sounds technical.
It is, but it's a simple concept. It's the triad that makes trading work. First, you have the securities exchanges like the NSE and BSE. They provide the trading platform and ensure fair price discovery.
They're the marketplace.
The marketplace. Second, you have the clearing corporations.
What's their job? This is where it gets a bit fuzzy for me.
Their job is to guarantee the trade. They manage counterparty risk. If you buy a stock and the seller defaults, the clearing corp steps in. They ensure you get your stock, and the seller on the other side gets their money. They handle the entire settlement of funds and securities.
So they're the guarantor, the middleman that makes the system trustful.
The ultimate guarantor. And the third part of the triad, the depositories. In India, that's NSDL and CDSL. This is where the electronic holding of assets happens. The process is called dematerialization.
So the exchange is the store, the clearing core is the cashier who guarantees the payment, and the depository is the digital vault where you keep what you bought.
That is a perfect way to put it, a fantastic analogy.
Yeah.
And connected to the depository, we have depository participants, DPs.
All right, the text uses an analogy here too.
It does. It says the DP is to the depository what the bank branch is to the central bank. You and I, as investors, can't go directly to NSDL to open an account. We open an account with a DP.
Which is usually your stockbroker, right?
Often, yes. Your broker is also your DP. Now, speaking of intermediaries, let's define a few more that the text lists. Custodians.
Who are they? They sound similar to depositories.
They're different. Custodians manage securities and funds for very large institutional investors, like foreign institutional investors or big mutual funds. Their needs are too complex for a standard DP account. They need a specialized custodian service.
Okay. Stockbrokers are easy.
Registered members of the exchange, mandatory for secondary market access. You cannot trade on the exchange without a broker.
What about investment banks? How are they different from a regular bank?
Very different. They provide strategic advice. Think mergers and acquisitions, M&A, project financing, valuations for big deals. They aren't taking your savings deposit. They are structuring massive corporate transactions.
And investment advisors, IAs,
They provide personalized investment advice to clients based on their risk appetite and financial goals. This is a specific regulated role under SEBI. They have a fiduciary duty to their clients.
and finally, R&T agents, registrars, and transfer agents.
These are the guys doing all the backroom work. They maintain the records of who owns what. They process dividends and corporate actions. They send out the annual reports. If you get an email about a dividend payment, it probably came from the company's R&T agent.
Got it. Let's talk about the products themselves. The text lists a few different vehicles for investment.
Right. You have the bond market for debt issuance. Then you have the derivatives market.
Okay, definition time. What is a derivative in simple terms?
It is an instrument that derives its value from an underlying asset. The asset could be a stock, a commodity, a currency, anything.
And what is it used for?
Two main things, and they are polar opposites. Hedging, which is about risk reduction, or speculation, which is about taking on high risk for a potentially high return.
So a farmer hedges against falling crop prices, but a day trader speculates on which way the Nifty will move.
A perfect example. Then we have the familiar mutual funds. Pooled money from many investors, all managed by professionals.
But then there are also alternative investment funds, AIFs. How are they different?
AIFs are for more sophisticated, high net worth investors. It's a private pooling of funds, and they often invest in things that mutual funds can't, like private equity, venture capital, real estate, or complex hedge fund strategies.
So higher ticket size, more exotic investments.
Exactly. And then you have portfolio managers, PMS.
How does that differ from a mutual fund? Aren't they both managing a portfolio?
They are, but the structure is different. In a mutual fund, everyone owns the same units of the fund. It's pooled. In PMS, the manager buys and sells specific stocks directly for your individual DMAT account. It's customized management.
I see. It's a bespoke portfolio, not an off-the-rack one.
Well said. To wrap up the securities section, the text mentions a couple of process enablers. Yes. First, KYC registration agencies, KRAs. They maintain a centralized database for your Know Your Customer documents. The idea is simple. You shouldn't have to submit your PAN card and address proof 10 times to 10 different brokers and funds.
Do it once, and everyone can access it.
You do it once, it's stored in the KRA system, and other intermediaries can verify it from there. For individuals, we also have the CKYC registry, which serves a similar purpose across the financial sector.
And the other enabler, credit rating agencies.
Absolutely crucial for the debt and bond market. They assess the creditworthiness of the companies or governments that are issuing bonds. They give standardized ratings like AAA or BB so investors can easily understand the risk of default.
We are in the home stretch. Section 5, Insurance and Pension Markets.
Let's start with insurance, which is regulated by IRDAI. The text divides it into two big buckets, life insurance in general or non-life insurance.
Under life insurance, it mentions a split between traditional plans and ULUPs.
Yes. Traditional plans are things like term insurance, which is pure risk cover. You pass away, your family gets paid. Or an endowment plan, which is a mix of risk cover and savings.
And ULEPs, unit-linked insurance plans.
ULPs are different. The premium you pay is split. Part of it goes to your life insurance cover, and the other part is invested in the stock or bond market, much like a mutual fund.
So the returns on a ULP can fluctuate with the market.
That's the defining feature, yes. Now, for general insurance, it's everything else. Motor, health, travel, fire, basically ensuring your non-life assets and well-being.
Who are the people who sell these policies?
The intermediaries. And the text makes a very important distinction here that you must remember. Insurance agents represent the insurance company,
Okay.
whereas insurance brokers represent the customer.
Oh, that is a key difference. So an agent works for the seller, trying to sell their product. A broker works for me, the buyer, trying to find the best product from any company.
You've got it. It's a fundamental difference in who they work for. The text also mentions surveyors, who are the independent professionals who assess the loss for a claim, and TPAs, third-party administrators, who mainly process health insurance claims for the insurance companies.
Okay, that's clear. Finally, the pension market under PFRDA. Why is this sector getting so much focus?
Two big reasons: a growing elderly population and the need for a reliable old age income. The text highlights a massive shift in how pensions work in India, a shift from defined benefit to defined contribution.
What's the difference between those two?
In a defined benefit plan, which was the old government pension system, the employer guarantees you a fixed pension, usually based on your last drawn salary. The employer, or the government, takes all the investment risk.
Okay.
In a defined contribution system, like the NPS, National Pension System, you and your employer both contribute a certain amount to your pension account. That money is invested, but the final amount you get depends on how those investments perform.
So the employee takes a risk.
Exactly. The risk shifts from the employer to the employee. The NPS is voluntary, defined contribution, and it's available to government employees now and also to the general public.
And what about people in the private sector?
The text mentions the EPFO, the Employees Provident Fund Organization. They cover the organized private sector. That is a separate mandatory system from the NTS structure mentioned under PFRDA, though they both serve the same goal of retirement savings.
Wow.
Yeah.
We made it. We took apart the engine and the transmission system piece by piece.
We did. It's a dense chapter, but if you visualize the buckets, regulators, banks, securities, insurance, pension, it becomes manageable.
So if you had to give a 30-second cheat sheet summary for the listener driving to their exam center right now, what is it?
Okay, rapid fire. 1, understand the distinction between money market, short-term, less than a year, and capital market, long-term. 2, know your 4 main regulators: RBI for money and banks, SEBI for securities, IRDAI for insurance, PFRDA for pensions. 3, don't mix up the Department of Economic Affairs, policy architect, with the Department of Financial Services, institution manager. 4, remember the MI triad: exchange, clearing core, depository. They make trading possible.
And the final exam tip, the one thing to cram in the last 5 minutes.
Dates and acts: SEBI Act 1992, Companies Act 2013, SCRA 1956, IRDAI Act 1999. These are easy marks if you just memorize them, don't leave them on the table.
And for anyone who's zoned out during the Ministry of Finance section, go back and listen to that part again. It's tricky.
Absolutely. The devil is in those departmental details.
This has been a deep dive into NISM Series-X-A, Chapter 5. We really hope this helps you ace that certification.
Good luck. Keep learning.
See you next time.